Hello and welcome to this special video on demand. In today's video, we're breaking down one of the most confusing areas of US taxes for NRIs and international students. How your residency status completely changes the way you are taxed. We're not just talking theory. Instead, I'll walk you through 4 real-life case studies from an F1 student filing Form 1040 NR to someone transitioning into a resident, to complex dual status situations, and even a smart strategy that can legally reduce your overall tax bill. By the end of this video, you'll clearly understand which income you need to report, which benefits you can or cannot claim, and how a small change in status can significantly impact your taxes. Let's get started with our first case. Let's go through case study 1, that is about an F1 student. The name is Priya. Her visa status is F1 student. She arrived in the USA in August 2024. She has 2 sources of income. First is an on-campus job from which she earns $8,000. Second is a scholarship worth $15,000 which covers both tuition and a stipend. She also has a bank account in India. Now let's look at her tax status. Priya is in her very first year in the United States. She is exempt from the substantial presence test. This means her filing status is non-resident alien and she will file Form 1040 NR. Now let's understand how her income is taxed. Since she is a non-resident alien, she only reports her US source income. This includes her $8,000 in wages from the on-campus job. For the scholarship, only the stipend portion is taxable. The tuition portion of the scholarship is completely tax-free. Now let's look at the benefits available to her. Since Priya is from India, she can take advantage of the US-India tax treaty. This treaty gives Indian students a special benefit, which allows her to claim the standard deduction. Also, since her job is on campus, she does not have to pay Social Security and Medicare taxes on that income. However, there are certain benefits that are not available to her. She cannot claim education credits like the American Opportunity Tax Credit or the Lifetime Learning Credit. She also cannot claim the Earned Income Tax Credit. She is also not allowed to file a joint tax return. Finally, here are the 2 most important things to remember about Priya's case. First, she does not need to report her Indian income at all. Second, the treaty benefits she claims will help reduce her overall tax liability. Let's go through case study 2, that is about a student who becomes a resident alien. The name is Rahul. His visa status started as F1 student, then moved to OPT and eventually changed to H1B. He has been living in the United States for more than 6 years. He has 2 sources of income. First is his salary from which he earns $75,000. Second is interest from a fixed deposit in India from which he earns $2,000. Now let's look at his tax status. Since Rahul has been in the United States for more than 6 years, he now passes the substantial presence test. This means his filing status is resident alien and he will file Form 1040, which is the standard tax form used by US residents and citizens. Now let's understand how his income is taxed. Since Rahul is now a resident alien, he must report his worldwide income. This means he reports his full US salary of $75,000. He must also report the $2,000 of interest income earned from his fixed deposit in India, so his total reportable income is $77,000. Now let's look at the benefits available to him. Since he is now filing as a resident alien, he can claim the standard deduction. If he is still studying, he may also be eligible for education credits like American Opportunity Tax Credit or the Lifetime Learning Credit. If he has children, he may also be able to claim the Child Tax Credit. Most importantly, since he is being taxed on his Indian income in the United States, he can claim the foreign tax credit to avoid paying tax on the same income twice. Finally, here are the 2 most important things to remember about Rahul's case. First, once a person becomes a resident alien, their global income becomes taxable in the United States, not just their US income. Second, Along with this added responsibility, Rahul also unlocks the full range of tax benefits and credits that are available to US residents. Let's go through case study 3, that is about a dual status taxpayer. The name is Amit. His visa status is H1B. His timeline in the United States is a little unique, and that is what makes his case more complex. From January to May, Amit was a non-resident alien. Then from June to December, he became a resident alien. This means in the same tax year, he was both a non-resident and a resident at different points in time. He has two sources of income. First is his US salary, from which he earns $60,000. Second is rental income from a property in India, from which he earns $5,000. Now let's look at his tax status. Since Amit was a non-resident for part of the year and a resident for the other part, he is classified as a dual status taxpayer. Because of this, he has to file two forms. He will file Form 1040 for the resident period and Form 1040 NR as a statement for the non-resident period. Now let's understand how his income is taxed across these two periods. During the non-resident period, that is from January to May, Amit only needs to report his US source income. During the resident period, that is from June to December, he must report both his US income as well as his Indian rental income of $5,000. So the Indian rental income is only taxable for the second half of the year, when he was a resident. Now let's look at the limitations that apply to Amit's case. Since he is a dual status taxpayer, he faces some significant restrictions. He cannot claim the standard deduction. He is also not allowed to file a joint tax return with a spouse. Additionally, he cannot claim most of the major tax credits that are normally available to full-year residents. Finally, here is the most important thing to remember about Amit's case. Because he loses access to the standard deduction and most tax credits due to his dual status classification, he will likely end up paying higher taxes compared to someone who was a full-year resident. This is one of the biggest challenges of being a dual status taxpayer. Let's go through case study 4, that is about a dual status taxpayer who makes a smart tax election. The name is Neha. Her situation is very similar to Amit from case study 3. Meaning she was also a non-resident for part of the year and a resident for the other part of the same tax year. Additionally, Neha is married and her spouse is currently living in India. Now let's look at her tax strategy. Instead of filing as a dual status taxpayer like Amit did, Neha makes a smart choice. She elects to be treated as a full-year resident alien for the entire tax year. This means instead of filing two forms like Amit, Neha simply files Form 1040, just like any other full-year resident. Now let's understand what this means for her income reporting. Since she has chosen to be treated as a full-year resident, she must now report her worldwide income for the entire year. This includes both her full US income and her India income for all 12 months of the year, not just for the resident period. Now let's look at the benefits she gains by making this election. Since she is now filing as a full-year resident, she can claim the standard deduction which was not available to Amit. She can also file jointly with her spouse even though her spouse lives in India. This is a significant benefit. She also gets access to a full range of tax credits that dual status taxpayers cannot claim. Now let's look at the trade-off involved in this decision. By choosing full-year resident status, more of her income becomes taxable since she is now reporting worldwide income for the entire year instead of just part of it. However, because she gains access to the standard deduction, joint filing status, and various tax credits, her overall tax bill may actually turn out to be lower than it would have been under dual status filing. Finally, here are the two most important things to remember about Neha's case. First, sometimes agreeing to pay tax on more income can actually result in a lower overall tax bill. Second, And most importantly, smart tax strategy and planning matters much more than just simply following the basic compliance rules. Knowing your options and choosing wisely can make a significant difference in how much tax you actually pay. Quick comparison. These examples show that your tax outcome is not just about how much you earn, but how your residency status is classified. A small change in status can significantly impact your tax liability. For more simple, practical NRI tax guides, don't forget to subscribe.